Good afternoon, everyone. I first want to thank you all for taking the time to join the call today as part of Kepler's Alternatives for Income Investors series. We're joined by Dean Orrico, CEO, and Rob Lowson, CIO of Middlefield Canadian Income. To start with some housekeeping, the presentation part of the call will last for approximately half an hour and then will be followed by a short Q&A session. All participants will remain on mute throughout the call, and please could I ask that any questions are submitted via the Q&A box towards the bottom right-hand corner of the screen. We will hopefully have time to answer as many of these as possible and do our best in the time permitting. During the call, Dean and Rob will be looking to provide some further colour on the structural drivers behind the Canadian equity market and looking to provide some food for thought for those investors seeking cash flow from a diversified portfolio of stable and profitable businesses. We'll be finishing the presentation with a short summary of why investors should consider allocating to Canada and to reiterate why we believe the trust is well placed in the current macro environment. So without further ado, I will pass on to Dean and Rob.
Thank you, Ed. Good afternoon, everybody. Thanks for joining us today. I'm going to talk a bit about the background on the fund and why we think allocating capital to Canada makes sense at this point in the economic cycle, and then I'll turn it over to Rob, who will give a bit more information about how the portfolio is positioned, and again, confirming that we think this is a really attractive investment opportunity for investors looking for some exposure to a market that we believe is more stable and pays high and growing levels of dividends, which we think is increasingly important given kind of where we are from a macroeconomic standpoint. And that's really what we're trying to describe on this slide number 2, where if you look back over the past 20 years, we think there's been some very distinct eras where, say, from 2000 to 2010, China came into the World Trade Organization. As a result, there was a super cycle in commodities, and that came to an end in and around the global financial crisis. And then from that 2010, 2021 period, we had an era of low to zero interest rates. Effectively, money was free, and the market was all about growth stocks. And for those of you who have any familiarity with Canada, we really don't have a technology sector. The Canadian market is largely comprised of value-based, dividend-paying companies. So given where we are today, in an era where we think inflation is going to remain higher, and since the middle of last year, interest rates are higher and we think will remain higher as well. When you take these macroeconomic factors together with the geopolitical factors which have brought hydrocarbon energy back into focus, we think the next 8 to 10 years is a period where Canada is going to be poised to outperform again. And as you can see on this particular slide, the Canadian equities are actually trading at a significant discount to their US counterparts. So again, even from a valuation standpoint, we think Canada is poised to outperform. So we think this merits attention for investors looking for exposure that is differentiated from what you're getting, say, in the US market. The other important things to highlight about the Canadian market are, number one, we are a net exporter of oil, gas, and electricity. So again, when you think about those commodities, which we think will be in increasing demand and have constrained supply, in Canada right now, we pay petrol at about half the cost that you're paying here in the UK. Our electricity prices are some 30 to 40% less than you're paying here in the UK. So not surprisingly, inflation has actually been less in Canada than you've got in the UK or Europe, as well as less than what you've seen in the US. So as a result, the Bank of Canada stopped raising rates in January of this year because of that lower inflation. We have an abundance of these commodities which have been driving inflation. The other important thing to appreciate is that we've got high levels of immigration into our country, and that's keeping a lid on labor costs. So it's been another major source of inflation for developed economies. And again, it's been lower in the Canadian market. So when we think about how this market's going to evolve over the next 8 or 10 years, we think Canada's got a number of positive things working for it. Let's talk a little bit about the fund itself right now. This is an equity income fund. It was launched in 2006. Rob and I have effectively been the managers of this portfolio since inception. And again, it's focused on income, which is really our business in Canada. We're an equity income asset manager. So this strategy that is traded here on the London Stock Exchange falls squarely within our core competencies. We pay a dividend of 5.2p per annum. That's a yield today of about 4.7%. That dividend was just increased in January of this year. We're running a covered dividend in 2023, and the board is focused on, subject to market conditions, to continue increasing that dividend over time. So subject to the performance of the portfolio and market conditions overall, that will be the objective of the fund as we go forward. We manage money in what we describe a high conviction portfolio. So that basically means we run stocks of 30 to 40 names in this fund, and each weighting is no more than 5%. So that's a means to control the risk in the portfolio, or less than 1%. So average weighting per issuer of 2.5 or 3%. On a year-to-date basis, the fund's done about 1% total return, relative to about 3% for our benchmark, so slightly lagging the benchmark. But since inception in 2006, we've got a total return in excess of 7%, which is exceeding our benchmark. Let me focus a bit more on the portfolio and how it's positioned. And in this particular slide, you can see that we've got about a 32% weighting in energy producers and pipelines together. So we put them in the same bucket because they're all under the energy umbrella. But as I say, about half of that exposure is in the actual companies who extract oil and natural gas. And we've got a very significant focus on natural gas in this fund, and Rob's going to cover that in more detail. But just as importantly, we also have exposure to pipelines, which is something that's quite unique to Canada or the US. You really don't have publicly listed pipeline companies here in the UK. And these businesses are highly stable. They're multi-billion-dollar market cap businesses. So companies like Enbridge or TC Energy really have a stranglehold on delivering oil and natural gas right throughout North America. And they're basically tolling type businesses, so they're highly stable and regulated, generate yields of about 5 to 7%, and those dividends tend to grow by 5 to 10% per annum. So these are very stable businesses with growing dividends, in the pipeline area. We also have about 15% in utilities and renewables businesses, and again, that's been a source of real stability in terms of income. Our biggest overweight, as you can see on this particular slide, has been in the real estate area, and I'm going to explain why we are as bullish on real estate in Canada right now. And then we've also got a healthy weighting in financials, which, as you can see on this slide, is actually below the benchmark weighting in financials. We've got a highly sophisticated and stable financial system in Canada, but as Rob will describe, for reasons we're slightly underweight the benchmark. So let's talk a little bit about the macro factors that make us so optimistic on the real estate sector in Canada. So the Canadian population is about 40 million people. And over the next 3 years, 23, 24, and 25, we're expecting new immigrants totaling about 1.5 million. So that's about 500,000 new immigrants per year coming into the into Canada. And if you just do the math, that's about in excess of 1% of our population. So that's by far the largest of any G7 country. So that's a significant demand on our housing in Canada. That's got a significant impact on the economy. And one of the things that Canada has actually done much better than other countries, including the US, is that we have a points-based immigration system. So we have a labor shortage in our country, and we've actually been attracting immigrants who are matching the labor needs. So about 60% of our annual immigration is coming in under what we call the economic class. These are people typically between the ages of 29 and 54 who are coming right into the workforce and contributing to economic activity. That's one of the reasons, as I alluded earlier, why our labor inflation in Canada has been lower, because we have an additional supply of labor coming in, given that overall labor shortage that we have in our country. The other important thing to appreciate about Canada is that about 80% of our total population is in 6 major cities. So yes, we've got this massive land base, but it's concentrated in major centers being Vancouver, Edmonton, Calgary, Toronto, Ottawa, and Montreal. So as investors in real estate, that makes it easier for us to identify the areas that we think will benefit most from this immigration. About 40% of all immigrants come to the Toronto area where Rob and I live. So that's about a 5 to 6 million person population base on a country, again, of 40 million people. So a very significant concentration in the Greater Toronto Area, the GTA. So again, we can better forecast the demand for certain types of real estate as a result. Just flipping slides here. So let's look at the various areas in which we're focused in the real estate market. We know real estate these days, from a sentiment standpoint, has really been challenged. But clearly, there are areas that we think have very, very solid fundamentals. They are industrial real estate, and these are basically the warehouses or the sheds. They are the apartment REITs. And then thirdly, these are the open air, grocery or necessity-based retail brick and mortar centers. They're not the shopping malls. So as a result, we have no exposure to the office market, which we think will continue to be very challenged for all the reasons that you've been reading in the press. And we have no exposure to shopping malls. So those are the areas that we think are more challenged, but very different from the fundamentals we're seeing in industrials, apartments, as well as the grocery anchored retail REITs. Virtually every one of our portfolio companies has just reported in the last 2 weeks Q1 results. And across the board, we've seen earnings that are exceeding consensus estimates. So as you can see on this slide, the expectation is that those earnings will continue to grow. And the way we look at real estate is like any commodity. It's a function of supply and demand. So we've continued to have constrained supply. So during the pandemic and even during this recent rise in interest rates, there's been very little new development underway. And then you've got continued growing demand. Again, a lot of it driven by that growth in population. So we are exposed to those REITs that have buildings in place. REITs are generally buyers. They're not developers of new buildings. So they're benefiting from that rising demand and able to increase their earnings and their rental rates, in some cases of 20 to 40% over leases that were in place. So again, the fundamentals continue to be very solid. And then by the same token, they've done a very good job in managing their debt. The average debt to gross book value in our Canadian REITs is anywhere between 20 and 40%. And they've been able to renegotiate that debt when interest rates were much lower than they are today. So in the last 5 years, the REIT CEOs have done a very good job renegotiating these mortgages at rates that are much lower than the rates that you're seeing in today's market. And we're seeing that in the results that they're putting up just in the past 2 weeks. So on this slide, you can see how our REITs are trading relative to their underlying net asset value. And this chart goes back to 1996. And as you can see, we're effectively at the lows. Our Canadian REITs are trading at 20 to 25% discounts to NAV. So the real question is, are those NAVs real? And are they reflecting the fundamentals that are in the market right now? NAVs are effectively a function of earnings over interest rates or capitalization rates. Virtually all of our REITs have been increasing their capitalization rates along with the increase in interest rates. But at the same token, and that would have a downward impact on NAVs because you're seeing your denominator go higher. But we're also seeing growth in earnings. And that earnings growth is more than offsetting that increase in capitalization or interest rates. So as a result, our NAVs have been quite stable. And one of our industrial REITs, as validation for this, was taken over in the last 3 or 4 months at a 30% premium to its trading price. It was acquired by a sovereign wealth fund in Singapore by the name of GIC at a significant premium. And that portfolio has been renewing its leases now, in some cases, 20 to 40% higher than the leases that are in place. So that's a very positive fundamental factor. So then the question is, if our NAVs are real, why are the trading prices so low relative to those NAVs? And I think there's a few reasons for that. Number one, we've seen interest rates increase so significantly and so rapidly in the last 12 months. And as I alluded earlier, Bank of Canada stopped raising interest rates in January of this year. So we think the worst is behind us in terms of rate increases. Number two, everywhere you turn, whether it's on the major business publications on TV or periodicals, everyone's talking about a recession. So there's people who are concerned about a recession and effectively waiting on the sidelines. And I think the other factor more recently is that we've had a regional banking crisis in the US. We've also had problems with the banks like Credit Suisse in Europe. And as Rob will describe, we're not seeing any of that in Canada. Our banks in Canada, we only have 6 of them, are extremely stable. And the lending environment for commercial real estate in Canada is also stable. So with that, we feel very comfortable in the types of valuations and the trading prices. And this is about as attractive an opportunity in REITs that I've seen in the last 20 years or so. So we think this is a real generational opportunity to get exposure to some of these really great companies. So with that, I'm going to turn it over to Rob. Just flip it, Rob, to the There you go.
Thanks, Dean. So I'm going to spend maybe 5 minutes on energy and 5 minutes on banks. And so between real estate and REITs, energy and banks, those are the core areas that how this fund is positioned, and all 3 areas we've got conviction on. So what's happened in energy over the last 2 years has been transformational in our opinion. The last decade, the world was focused on the energy transition, moving from fossil fuels and coal as quickly as possible with no afterthought to renewables and no thought of the implications. And the invasion of the Ukraine really highlighted and made both individuals, corporations, and governments all aware of the issues of that energy transition and the ramifications of doing it so quickly, and really created an energy trilemma for the world, which we think Canada can address and be a solution for. And that's why we're quite excited about our energy industry, the stocks and the equities here in Canada that can benefit from Canada being the solution to the trilemma. And the trilemma, the 3 things are really providing energy security, still the awareness of sustainability, and affordability. And all those things, I think, hit close to home to all the listeners here, given what happened over the last 12 months. LNG, liquefied natural gas, has been a solution to providing base load power, base load energy to Europe and the UK over the last 12 months and into last winter, which fortunately was more mild than expected, and was one of the main reasons why I think the UK and Europe did not fall into a recession. And the reason why LNG is an important factor here, liquefied natural gas obviously is natural gas, and it's a mobile form of natural gas. So Canada is the 6th largest producer of natural gas, and we're about to begin a journey in our first beginning of our industry of liquefied natural gas early in 2025. So we've been building out our LNG infrastructure for over the last 6 or 7 years, and very soon we're going to start to export our natural gas through a liquefied state, put it on a boat, and it's going off the west coast, the Vancouver coast of Canada towards Asia, to Korea, Malaysia, China. Shell is actually a partner in that project. But there's a real tailwind that that'll create for the companies we own in this fund, whether there are low-cost natural gas producers or our energy infrastructure companies benefiting from the increased volumes of natural gas being produced and moved to the coast. So that checks the box of security because Canada can be relied upon. It's an ally of most countries in the world. We're a major trading partner in most countries of the world. We're a safe place to do business. But natural gas in its commodity state is a secure form of baseload power that can complement renewables and more specifically solar and wind. So when you look at the sustainability of natural gas, because it can continue to complement the build out of renewables, it's sustainable, but it's also a lower carbon emitting fossil fuel. So it burns it emits half the carbon that coal does. So the whole world is trying to move out of coal, and many countries are moving from coal to natural gas, coal to LNG switch, and that is just low-hanging fruit to decarbonize the world. So there's 2 check marks there, security and sustainability, but also affordability. Canada has 300 years worth of natural gas resources. So, and they're very shallow pools of natural gas that we can get at quite quickly. So we've got a low-cost supply of natural gas. So the checks, Canada can be a solution here for the energy trilemma that all countries are dealing with. And, we're quite excited about, we're on the cusp of a new subsector for our energy industry. This portfolio should benefit for the next decade. The next slide here that you're looking at really just gives you some facts of the world LNG market. And globally, over the next 7 years, you're going to need 70% more LNG. And 70% of that growth is going to be supplied by North America. And as I said, Canada is just at the cusp of starting their LNG business. Currently, LNG is being exported off the Gulf of Mexico out of the United States, in the southeast part of the United States, but now the northwest part of North America through Canada, we're going to start to export LNG. So more volumes is going to, again, benefit our utility-like energy infrastructure companies, our pipelines and our midstream companies. In addition, as you can see from that table, energy is cheap in North America and it's expensive rest of the world. Those prices are going to converge. So our energy producers and distributors are going to benefit on the revenue line from both price and quantity. Price is going to go up and converge with world prices in our estimation, and quantity is going to increase because we're going to have to produce more natural gas and move more natural gas to meet the needs of the growing demand of the world. To your benefit, as we go the next decade, Europe and the UK and Asia, I think we'll see lower liquefied natural gas prices because more supply is coming on from North America, specifically Canada. So you're going to see LNG prices move from $15 to $25 where they are now in the world, probably down to about 12. And then you're going to see natural gas prices and LNG prices move from $3 to $6 in North America and probably convert into that 10 to 12 range. So it's a net tailwind to us because we're going to see positive prices for our energy companies. It's going to be a tailwind for you because I think that will help your inflation as we go through the coming years. Finally, on LNG this just shows you a visual representation of North America. The top right part of that map is Western Canada, and that's where we're going to go from 0 BCF a day of production now on LNG to 7 BCBs a day in 2030. And that's really where I wanted to highlight the growth for Canada. This slide talks about some of our major energy producers. Again, Tourmaline is our favorite natural gas producer. They're going to benefit from higher prices and volumes. TC Energy, a pipeline company, moves 25% of all natural gas every day in North America and is building pipelines to the west coast of Canada to meet the needs of our new liquefied natural gas industry. So two major holdings in the fund will benefit from that. In the interest of time, why don't I talk about Canadian banks? Financials and banks are obviously front page news, given what's happened in the regional banks in the United States. We've had some failures. Even Credit Suisse here in Europe has caused some jitters in the world financial markets. Canadian banks are viewed as safe. They're stable. Our banks, there's only 6 large banks in Canada. It's an oligopoly. They have pricing power. So unfortunately, Dean and I probably pay a little more than we should compared to what you're paying for banking services, but it allows us a stable industry that's well regulated, but not overly regulated. So there's our high return on equities for our Canadian banks. They earn 15% ROEs. Compare that to European banks at 6% ROEs. That's why our banks are more profitable and did not have to cut their dividends during the great financial crisis. They didn't cut their dividends through COVID. They paused them through those stress tests, but they are now post-COVID raising dividends again. And you can see that top right chart just shows the drawdowns across different banking regions. You can see Canadian banks during COVID had less drawdowns versus US and European counterparts. We haven't had a bank failure since 1996, and that bank was not a big 6 bank. It was a small mortgage lending operation out of Western Canada. So what the world views Canadian banks as stable, safe, sophisticated. And as you can see, if you look at share prices of our banks, they're some of the top performing banks constantly worldwide. This chart on the right, just kind of the dark blue are our Canadian banks showing higher liquidity ratios, and on the x-axis, higher capital ratios. So again, our banks are safe. Office real estate is a big major media attention focal point in the US because of the regional banks in the States. Their loan book is 20 to 30% in commercial real estate and a lot of office. Canadian banks, 10% of our loan book on average is commercial real estate. And of that, 10 to 12% is office. So they've only got 1 or 2% exposure to office. And typically our banks lend to AA type office that's well leased, buildings that Dean and I are Middlefield is in downtown Toronto, versus the B and C office space where you will see high vacancies. So Dean showed earlier our asset allocation. Financials in Canada is 30% of the index that we track. We're at about 20-21% financials, primarily banks. So we're underweight right now, not because we dislike banks, but typically going into a growth slowdown. We are seeing the consumer slow down. We're seeing business lending slow down. So if we're going into an economic slowdown, still to be determined whether we actually get into the most telegraphed recession that the world is anticipating. But regardless, financials tend to trade sideways or down going into a slowdown, and that's why we're currently underweight. But it wouldn't surprise us in a couple of years for you to see us back to market weight financials and banks in this fund. Quickly, we love dividends at Middlefield. We especially like companies that pay a growing dividend. You can see from that light blue chart, bar chart sleeve there, that's the portfolio. And our companies have shown that they increase their dividends quicker than other benchmarks. And that's something to be proud of. And with that, just to summarize, I'll let Dean leave you with a few talking points.
Thanks, Rob. So just to summarize, from a macro geopolitical perspective, we think the things that Canada does and does well and where we're focused are actually coming back into favor. And for the reasons we discussed, we think this period of higher inflation, higher interest rates, while not as high as they are today, we think will remain higher for the foreseeable future. Put differently, the days of zero interest rates and zero inflation, we think, are in the rearview mirror. And we think all of that conspires to make what Canada offers and what this fund offers very attractive. As Rob mentioned, we're focused on income. We've seen significant income growth in our portfolio. This fund has increased its distribution. The objective is to continue to increase its distribution or its dividend over time. So effectively passing on that increasing level of income that we're receiving in the portfolio. And given how the portfolio is positioned today across financials, across property, and with this very positive outlook on Canadian natural gas, which we think is going to deliver both high levels of income. Rob mentioned Tourmaline is one of our largest holdings there. The annualized yield on Tourmaline, when you include all of its special dividends, is about 10%. So they're passing on all that increase in cash flow to investors who are enjoying that and then flowing that through to investors in Middlefield Canadian. So with that, Ed, why don't I turn it back to you and you can open it up for questions.
Perfect. Thanks very much, Dean and Rob. Very, very insightful. So to move on through, we've had quite a few questions through, so we'll try and rattle through as many as we can. Just starting off with the fund's allocation itself. So the fund can allocate up to 40% in US equities. Could you just give a bit of insight into how the fund is currently positioned? Is there any US exposure? And perhaps over the past couple of years, how has that allocation changed?
Sure. So I think this allocation today is very reflective of our view on the market. So yes, we can go up to 40% US in this portfolio. And if you rewind, 2 to 3, 4 years, we were some 25 to 35% US weighted. But as we've just outlined today, we've got a relatively much more positive view on Canada, given everything that's going on in the world and the macro backdrop. So as a result, we're currently 100% focused on Canadian equities in this fund. We're getting higher income. As we showed earlier, we're seeing better valuations in Canada. And as we've been saying throughout the last half hour, we think there's a better outlook there too.
Perfect. That's very helpful. I mean, and again, no particular order, moving back onto your real estate exposure and the REITs, could you just provide a bit of colour on actually what subsectors and sectors you're currently allocated to? Is that residential, commercial, industrial, and where are you seeing the opportunities?
Sure. So when you look across the real estate spectrum, we think these various sectors actually behave quite differently. So today we have no exposure to office properties. We've got no exposure to shopping malls. So on office properties, we think there are going to be continued challenges there as the corporate sector figures out how they want their employees to work. And there's clearly less demand for space as we look at it today. As Rob alluded, there is a bit of a bifurcation in the office market where newer office buildings are more than 90% occupied, but it's those B and C properties that were built some 30 or 40 years ago that are sitting 40 or 50% occupied. And there's going to be a repurposing of those assets. But because that's a highly capital intensive and a lengthy process, we don't want to participate in that in this portfolio. We're looking for companies that we think there's real visibility on paying high levels of income. And that doesn't include office in the near term. Where we are focused, though, is in industrial properties. So the industrial real estate market in Canada is about as tight as we've seen it in the last 20 years. In Toronto, this is the second largest industrial property market in North America, second only to Chicago. We have vacancy rates of less than 1%. We're seeing releasing spreads in industrial property in the Greater Toronto market that are in excess of 20 and 30%. So we think there's real momentum there that, as far as we can tell, it's at least 3 to 4 years of runway before you see enough supply catch up to growing demand. So it's that imbalance between demand and supply right now that's creating such a favorable environment for industrial property. Apartment REITs is another area where we have exposure. Again, when you think about that immigration factor, most immigrants coming to Canada tend to rent 5 to 7 years before they can afford to buy a home. So we think there's going to be growing demand for rental properties. In addition, Canada has the lowest level of housing per capita of any country in the G7. So that's just exacerbating the issue with all this new demand coming in. And that, last but not least, that third area that we're exposed to is grocery anchored retail brick and mortar, not shopping malls. These are open air centers that are typically anchored by one of Canada's major grocers like a Loblaws or a Sobeys, or anchored by, say, a Walmart. Walmart just reported numbers this morning which showed a beat on both brick and mortar as well as online sales. So having them as an anchor tenant for Smart Centers REIT that we own in this portfolio, about 75% of Smart Centers assets are actually anchored by a Walmart. So we really derive real benefit from that. So those are the three sectors that we really like because the fundamentals are so strong: industrial, apartments, and grocery anchored retail.
Perfect. And just carry on with REITs and residential. Are there rental controls in Canadian cities? And if so, how does this affect valuations?
Sure. So in Ontario, where Rob and I live, this is the largest province in Canada. About 15 million of Canada's 40 million people live in Ontario. And this is where the vast majority of our immigration comes. So as I alluded earlier, about 40% of new immigrants find their way into the Toronto area, which is in Ontario. So yes, we have rent controls. And the way it works is that an existing tenant who renews their lease year after year, the landlord can only increase that rent by a maximum of about 2%. However, when the tenant vacates that property and a new tenant comes in, the landlord can actually mark it up to market rates, and those market rates are on average between 20 and 30% higher than the rent that's in place. So overall, Canadian Apartment Properties REIT, which we own this portfolio, saw same property NOI growth of about 8 or 9%. So that's a blend between those leases that are rolling over with existing tenants at 2%, plus leases rolling over with new tenants at 20%.
Perfect. Thank you very much. And just moving on, in terms of LNG, given the European energy crisis that we've just come through, could you just expand on the current relationship between Canada and Europe and what contracts are currently in place?
Sure. Yeah, the majority of LNG from North America that reach the shores of Europe and the UK come from the United States in the facilities that are built in the Gulf of Mexico. So Canadian natural gas makes its way through the pipeline network south into the United States, and some of it by default will, on a no names basis, we don't know, all the molecules kind of get commingled into the pipeline, will make its way over to Europe. But Tourmaline, and there's another company called Arc Energy, which we've owned from time to time over the last 20 years, are negotiating specific contracts with Cheniere, who's a major provider of LNG in the United States, where a specific cargo ship will be a Tourmaline ship. And they want, again, our low cost, low emission natural gas and the security of the largest gas producers in Canada. So the supplier of LNG also wants a diversified approach, just like we manage our portfolios diversified. They don't want to rely on one single producer. Let's say it's ExxonMobil, in case something goes wrong in ExxonMobil and a certain gas field gets shut in. Just like Europe doesn't want to rely solely on Russia for natural gas. So our Canadian producers over time you'll see more direct deals done to get some specific gas to Europe. And just to quickly, our gas costs about $1.50 to get out of the ground. Transportation costs are about $1 to get it to the coast. So our all-in costs are about, for our producers that we own, $2.50. So when gas is traded at $3.50, they're making a 30% margin, which is pretty good. To liquefy it costs about $4. So $2.50 plus $4, all-in cost is $6.50. you're willing to buy that gas because the world market is, $15 for gas. So we're very cost competitive, North American natural gas.
Thank you. And just moving on again to the banks, given everything that's happened in recent months in the US and Europe, how exposed are Canadian banks to these regional banks? Is it providing an opportunity for likelihood of increased M&A, or it just useful to get some further insight?
Yeah, there's not much direct exposure. TD, Royal Bank, and Bank of Montreal over the last few years have bought a few regional banks, but in the United States. So they do have exposure to the US. They're trying to grow their business, but it's very small. So there's no worry from or contagion from that standpoint. In fact, we view it as an opportunity for those three banks because, how I stated earlier, Canada's reputation is safe, secure banking industry. We think more individuals in Silicon Valley, more individuals across the US, businesses will want to do more business instead of with their local regional bank, US based. Again, there's 4,500 of these in the United States. Will want to partner with, probably more JP Morgans, but also Royal Banks, TD Banks, BMOs, because you're partnering with someone with a solidified balance sheet and capital ratios.
Perfect. That's very helpful. And just looking more widely, again, on the subject of the US, I mean, what are your thoughts on the likelihood of a US recession? Do you have a sort of time frame in mind? And actually, what would be the potential effects to the Canadian market?
Yeah, our house view is that we are going to see an economic slowdown this year. And, clearly, given that the US is our largest trading partner, that will have an impact on Canada. But generally speaking, what we've really seen is this rolling recession, whether it was in housing 2 years ago, whether it was in technology last year, whether it was in financials this year. It just seems to be hitting different sectors at different times. So that's why we think, this is generally going to be a more mild as opposed to a more severe recession. But even with that, we feel much more comfortable owning stocks that already have a lower valuation. So in Canada, we're trading at 3 to 4 turns below where the US market's trading. So we have a margin of safety built in there. The other margin of safety that we're getting is by virtue of our higher dividend. So that also gives us comfort because even though the markets might show some volatility through an economic slowdown, we're actually being paid to wait through these higher dividends. So we think that's a better allocation of our capital.
Perfect. And just on the subject of that dividend, what percentage of the dividend is covered by natural yield from the portfolio? And can you just expand on the dividend cover at the moment?
Yeah, so last year we had a more than covered dividend. So that's why we actually, the board announced early this year to increase the dividend. And last year it was about 10 to 15% higher than the dividend that was being paid. That was the coverage. And so far in 23, we're running excess coverage on the dividend as well in terms of the actual cash, net cash that's actually being earned by the portfolio. So this is after expenses. So again, as I alluded earlier, I think the board's going to continue to view ways subject to that continued excess coverage, deliver that excess income to investors in the form of higher dividends, if that maintains itself going forward.
And again, just focusing on the fund structure, could you just give some insight into the current gearing levels employed by the fund?
Sorry, what was that, Ed?
The current gearing levels employed by the fund.
Yes, so we can actually borrow up to 25% of total assets. And we use that gearing somewhat tactically. Today, we're at about 15%, 15% net gearing, which is indicative of our comfort level on the market. If we were really of the view that we think the markets were overvalued or got ahead of themselves, you would see that gearing at a lower level. But at 15%, that's indicative of how we feel about the value that we're getting in the market. So it's a modest amount of gearing, but we think it does provide some additional opportunity to earn some additional income in the fund.
Perfect. And just conscious of time, I think we've got time for just one more question. Sorry, just a quick look. choosing a good one to finish on. Apologies. In terms of, again, in terms of natural resources, which Canada is obviously very rich in, there's been a lot of talk of the slowdown in China. What could be the potential implications for Canada? Is this again an opportunity?
Yeah, if you get a slowdown in China, from this fund standpoint, I think you'll have, oil prices drift to the $60 range from 75 where it is. Our oil companies we own in this portfolio can hold their dividends, and they say they can continue to grow their dividends at $45 plus. So I think we're still in good shape. Share prices might come down a little bit, but from the dividend coverage and that standpoint, I think we're okay. But I think that would be the main issue. I think would be our oil exposure in the portfolio. There's not a lot of other base metal exposure in the portfolio. That can affect iron ore prices, coal prices, copper prices. This fund doesn't have exposure to those currently.
And as Rob said, our primary exposure on fossil fuels is on natural gas, which it really operates independent of what's going on in China. The buyers there are primarily kind of the US or Europe.
Perfect. Well, I think we will wrap it up there, just being conscious of time. Thank you very much for your time, and thank you to everyone who dialed in. Hopefully you've all got sort of further ideas and insight into why Canada is looking attractive in the current environment. Just as a very quick reminder, we'll have one more call tomorrow as part of this alternative income investors series with UK commercial property REIT. Thank you again, and goodbye.
Goodbye. Thank you.